Hello everybody and welcome back to another video. In today's video we discuss everything to do with the stock, crypto and commodities markets right now and look at the key levels that you should be watching over the next sessions. We've seen a big gap movement here in the stock markets due to tensions easing in Europe. But the question is, was this more of a rally that then begins a bigger sell-off, or is this actually the beginning of a big turnaround? We're at a critical point coming into the next 24 hours and we've got the Fed coming out with a statement. Stay tuned to find out more. All right, well, welcome back to our daily recap show here where we cover off on stocks, cryptos, and commodities. And if any of that stuff interests you, then of course, please remember to subscribe and smash that like button if you do end up enjoying the video. We've got here the market recap for the 15th of February, 2022. It's hard to believe we're already that far into 2022, but we are. And it's been one of the wildest times since, of course, the pandemic in terms of market action. Here we have a heat map of the S&P 500 and you'll look at the left-hand side and you'll say it was all green, all good. Growth was back in form, Nvidia moving up into earnings, 9.18%. And then we have Tesla as well, having a nice day trade on it, 5.33%. So Tesla bulls will be happy. You'll notice on the right-hand side, energy wasn't doing so well. And we'll take a look at that a little bit soon. But let's talk just quickly about what we're actually seeing in terms of broader economic problems. Now, we are all aware of inflation. We're all aware that this is the big concern about the markets. But I like to think about markets all being interconnected. And I think that's a really big thing here for the community. And when you understand that all markets are interconnected, one of the things that you look for in crashes is obviously broadening your horizon past the stock market, past the crypto markets, and saying, okay, let's look at the broader picture. Because when corrections or crashes happen, people freak out. How do we get ourselves, I guess, a little bit better in terms of our feelings about the market? Here's a question about household mortgage debt versus percentage of GDP in America. And you'll notice that actually it's come further down over the last couple of years since the GFC. We're not anywhere near the levels of, let's say, debt that we were before the global financial crisis. This is an important chart to continue to watch throughout the next couple of years and really start to look for upticks in this. If we see household debt increase at astronomical rates like it did over here during that 2000 to 2006-7 period, you have to start to be concerned about the mortgage rates and whether people can repay them. Remember, this is one of the biggest markets in the world. In fact, it is. And it's very important to be able to know how that market works because it does feed back into the stock markets. Let's also talk about here and go into the broader markets of what happened during the session. IWM, Nasdaq, S&P 500, they were all up, so with the Dow. We saw IWM, the small caps, do the best, followed by Nasdaq. And I think a lot of these small caps were the hyper stocks. They were really moving heavily and very bullishly throughout the session. And many of these hyper stocks, and we'll look at ARK a little bit later in today's video, are starting to form phenomenal bases. As we've stated, all of 2022 and even the back end of 2021, once we find the bottom on hyper stocks, they will probably be the highest percentage returns for the 2022 period if we're able to time it correctly. And I think they're starting to look a little bit better than they have been. Let's move over here to the best sectors of the day. Well, our little favorite Jets is doing all right, 5.73% on Jets. We've been talking about that sector for a while and it's done well over January into February. It's kind of like the recovery play, and I guess it is now actually starting to recover quite nicely. Gold was doing the worst. It hit our resistance that we talked about, sold off, but doesn't mean that gold's done yet, and we'll talk about that later. And everything else was in between. Semiconductors doing really well, led by Nvidia, and same with solar doing incredibly well through the session. Now, speaking of Nvidia, we have Shopify before the open Wednesday, obviously Crocs as well. Those will be some interesting announcements, but Nvidia is the big kahuna here. After the close, after the Fed, we will see Nvidia's result. And we've got some breakdowns that I think might be important for people to understand, which are just really around risk management and your expectations coming into these announcements. And I think you might find that quite interesting. So stay tuned for the rest of the video as we will cover off on it. In terms of seasonality, we'll bring this chart up quickly. We've talked it a lot through. We always expected the first quarter to be pretty poor in midterm election years. You'll notice here 2018, 2014. They average off to a pretty poor first quarter. 2018 has many hallmarks than 2022 because, of course, not only is it a midterm year, but the Fed is also raising rates, very similar time. And based on the yield and what we'll talk about later, it seems to be kind of a very similar process of what we might see is raising rates and then some declining rates once they get inflation under control, if they're able to do so. So if you're feeling optimistic about the markets, we still think there's sideways action here for maybe February into March. And as we see that real fact kind of coming through, the first raise of rates, we might even actually see the market start to tip into the positive sector for the middle of the year. That seems to be a very seasonal thing that has occurred before, and it seems to be holding true. We also know that these midterm years are overall very negative, or traders markets for a lot of the year, investing at certain points. But if we get through with the right stuff, come Q4 of 2022 into Q1 of 2023, there could be phenomenal returns. So make sure you subscribe as well, because we'll be following that very closely throughout the year and seeing if we can pinpoint that time. Earnings beat data still remains really good. The economy looks pretty good from the surface, and the beats data is 757 versus 288. So expectations are very good this earnings. It hasn't really disappointed. Obviously, Facebook wasn't great, but in general, most of these companies aren't exactly showing weakness at this stage. And it does broaden our horizons past the current correction that we're in, due to really an attack on growth more than any other sector. And we detailed again that in the last video. Let's take a look at the VIX. So the VIX has dropped, and it is because the market has gone up. The tensions in Europe have supposedly faded for now. And some people like to TA the VIX. I always look at it from just purely a big supports resistance kind of level. We've always known this 32 is a bit of a resistance, and even when it spiked through, generally that would be a pretty good little take profit or scale back. The market's come back down now to previous little bit of resistance over here, and I guess that could be acting as support. So if you're a VIX trader, maybe you like the idea of volatility rising again. I think that's fair when we look at the SPY a little bit later on. I think it's going to make a lot of sense to you. Let's take a look at the US 2-year. So this is where we need to understand some things about the current yield curves. So we've got the 2-year sitting at almost 1.6%. Now, why is it sitting at resistance? It's awaiting the core retail sales figure, and also we're awaiting the FOMC meeting minutes. So these minutes and all of the things that are said around there, plus the economic news, are either going to bull this 2-year up further, or they're going to, of course, bring it back down and probably move the markets accordingly. But remember, 1.6 approximately on the 2-year, and the 10-year is sitting at 2.043. So really what that's saying is that we might see a rate hike similar to 18, and then once they get inflation under control, there's a good chance they'll actually start rate cutting, with following rate hikes after. They're not saying that the new norm so far, at least the yield markets, is like a 2.5–3% over the long term. I think the new norm is somewhere more like 1.5%, and it comes down to government debt really at the end of the day. The government can't afford to pay debt off at too high a rate. So just remember that it's a weird time. The 10-year is not that much different from the 2-year, and that's what it's pointing to. It's pointing to a rate hike followed by a forced cut once they manage to get the economy under control. Let's move over to gold. So gold hit our 1870 target. We knew that was going to be resistance. If you have a look at a daily, it's very clear that this was going to be a resistance, and gold has pulled back to the previous resistance, which should act as support. So I've brought up here a little 15-minute 1-hour chart. Let's just have a look at it. So the 1 hour here, 20 and 50 exponential moving average, sitting around this 1857. For day traders, they're looking at this and probably saying, okay, we've got some higher lows coming in, and if we breach this zone, the next logical target is to go back to 1870. So I think there's a lot of traders that are waiting for confirmation here on gold, and while it has pulled back, if it's able to get back above this little red box area here, it could be a significant move over the next 24 hours. Certainly gold's not done yet, even though it looks like it's falling back. Silver will be similar. It will follow gold's lead in terms of what it's doing. Now, we talked about the tensions easing, and oil, of course, plummeted due to that. Now, oil is getting a lot of calls now for $100. Everybody's got this idea that $100 is going to happen on oil. I'm not so convinced that it's necessarily going to happen straight away, and I've detailed many reasons why, the biggest one being it's too far away from the mean reversion. Markets can do anything, but when they tend to go this far away, that is 18% in terms of distance from mean reversion, it's basically saying that we're a bit hyperextended. 4-hour 50 exponential moving average has been something that we've followed throughout this bullish trend here on oil, and it's starting to come under pressure. So you've got to ask yourself the question, is this a little double top? If it gets under this low that it just formed, and obviously it's bulling off that level again, a very good support, no doubt. If it gets underneath there, be a little bit scared, oil traders, because energy is outperforming the market by an incredible amount. And in terms of where it's leading, people, if they believe the markets are turning around as well and going bullish, are going to rotate out of energy and they're going to rotate into the next best sectors, which are going to be some of these beaten down ones. It's just the nature. If you want to outperform the market, are you going to stay in energy moving forward, or are you going to descale your position a little bit, grab some of the others, and then move back into energy during a dip? That's something that I think is opening itself up right now. Let's talk about Tesla before we get into the indices. Tesla had a really nice rally on it. It actually opened above our resistance that we spoke of yesterday. And because it did this, it continued rallying. From the surface, you would think Tesla is going to move towards that 945 again. That's kind of the general consensus most people would have. The only problem with the Tesla trade is not so much Tesla itself. It's going to be the SP 500 and the channel that we're stuck in, because all of the Nasdaq stocks closed slightly bullish. So you'll notice they all closed like this, little bullish here. But the problem I have with Tesla is not so much the stock itself, it's going to be the market. And I think that's where we're going to have to come back to Tesla a little bit later and talk about it. So support's now around $900. You'd expect some buying pressure to currently come in. That is previous support now acts as resistance, which acts as support. Good role reversal area. If the sell-off does occur, that might be a zone that day traders are going to try to pick up on. And if it does end up rallying, be careful for the 945, 950 area. That's going to be where there's a lot of resistance selling. Day traders will start to bail and get out. Before we go into other markets, we want to talk about Nvidia though, because often stocks go to a point of resistance, which in case this is before earnings, or a case of they go to support, similar to Amazon. It went straight back down into support. Earnings was, let's say, better than the expectation, and it went straight up. Now, if you're an Nvidia trader, it's a nervous 24 hours. You might have a lot of faith that they're going to have a good return. But I think the problem here is that we have currently a downward trend. We know that we're at a point of resistance. And if earnings breach it through, well, that's earnings. Next step you would think is bullish towards the 300. And probably if the earnings are really good, you'd expect the market to bull straight into the $300 target. That's the bullish side of things. The bears are looking at this and saying, okay, well, if it can't meet expectations, which would be a big drag on the semiconductors, we're at resistance, let's sell that off. And let's have a look at some of the things that we know about Nvidia during these types of years. Firstly, we'll bring up just PS ratio here. So this is price to sales ratio. They are a lot higher in terms of valuation than they ever have been. So is the growth curve earnings per share or sales per share very good? The answer is absolutely yes, it is. It's been doing amazing growth. The last time they saw a slowdown though was when we entered this period of kind of 2019. It kind of weakened there, and it actually continued up a little bit through 2018 through the crypto winter. But a lot of Nvidia's profit, or a lot of their bargaining and the way that people look at them, it's so much more than just graphics cards. But graphics cards do make up a bit of it. If crypto isn't doing well, does that mean that the sales haven't been fantastic for Nvidia? Demand's still incredibly high. Are they having any bottlenecks? These are questions that I look at. When I'm picking up stocks though for an investment, I also look at the history of how the stock's traded. Now we know that it's a new paradigm shift. There's no way it's trading back down here, but the average here on PS ratios has been somewhere around this level, which is between, let's say, a 16, a 7. So let's call it a 16 is maybe a pretty good value for it. It's now going up to a 25.28 on the PS ratio scale. That's pretty high in terms of what the market has to expect and the growth that's currently coming through. They've got to do a big number here to really represent what the market wants. And when we go over to seasonality during midterm election years, it's not all peachy for Nvidia. In fact, Nvidia has not performed well during mid-election years. This is just a bear case scenario, just a little bit of bringing some data together with it. But you'll notice it tends to do pretty poorly. And actually, Nvidia's best months of the year are historically these ones. This particular earnings curve, the August-September run, if you look at it over 15 years, it's incredible how good August and September are for Nvidia in comparison to other stocks in the market. But we've got this lone February increase, which is actually what we've been seeing right now. And then the rest of this middle kind of area hasn't been so positive. So this is, again, using past history. It doesn't necessarily mean it's going to come true, but it's going to be a very interesting 24 hours. And you might be sitting here saying, haha, Tom, told you Nvidia kick ass. I like to look at this as, if you're going to trade Nvidia, you might want to do it with something like an option. And we won't deep dive any further than that in that stock, but options, at least you can limit your risk, yeah? And there are ways of taking advantage of earnings seasons and things like that. Don't be freaked out. If you have a longer term plan, of course, you're not going to go and change your plan on longer term based on this. It's just something that I think about coming into an earnings. Do I want to own the stock, or do I prefer to risk mitigate? Something that some people do consider. Let's move over here to ARKK. And ARKK has really been improving. Hyperstocks, we talked about it, a series of higher lows and a real series of base, including high volume. We've got the 20 moving average. We know that's been a big deal. It's closed at that level again. And we have the trend line down, which has gone through the previous peaks. So we're looking for breakouts here past 77.50 to not only show that the market's ready to turn back around to the bull side, but also that maybe hyper stocks are getting really tasty in the markets, and we'll keep covering that off in the future. Let's also look at the bear cases here, and I think this is the best bear case, and we'll just quickly explain IWM. Basically, we have a leg down and a leg down and a potential for another leg down. Now, the pickup was around the same here as it is here. So that basically means it's going in like a wave, or effectively like a trend of legs is what I like to call it. And this is coming off the back of what we know is a Wyckoff distribution event. There's no doubt that this had taken a long time. It had that false breakout, which of course we were looking at last year, and we thought that it might continue on. And it turns out that this was pretty much a Wyckoff event. And that usually leads to weakness in the market. So if we believe inflation is at least going to be partially persistent here, the Fed can't control it, and we are feeling bearish. If IWM shows the cracks of this flag here going down, that is breaching back under this low that was formed just the other day, that could be very negative for the markets. And I think we'll follow IWM following this. Now, if you're a bull, 210, okay? We need it past 210. So there's a real contradiction between bulls and bears, and that's the tough thing. That's why we're saying when the VIX is above 20, when we're in this kind of period where we're still bullish on the markets over the medium long term, but we're kind of neutral to maybe even partially bearish on the short term, we've got to stay following the price action. Price action, price action, price action. Leave our opinions at the door somewhat. So that's our thoughts on IWM there. Let's move over to the Nasdaq. Everyone's pretty hyped about this. Obviously a big gap open here on the market thanks to tensions easing. It's then come up into the box that we talked about yesterday between 14.5 and 14.6. And I guess you would say, oh, it closed above 14.6, Tom. Yeah, the Nasdaq did do pretty well. But I've always said SP 500 is the key lead in market corrections. You have to watch the broad market, and then if you want to trade the Nasdaq, cool, that's excellent. If we believe it sells off, and we'll talk about the SPY in just a moment, then the fill of the gap will get us down to around this level here, about the 14,300 zone. And some people are going to be looking for that full gap fill, and rightfully so. If you're a bull, well, we're about to talk about the bull case in just a minute, but yes, the Nasdaq did well. It's come into a zone, and I think the SPY is the better place for us to be in terms of analysis. So the SPY, we talked about the double top. It sold off 3 days in a row, gapped up due to, of course, tensions easing. We now get to hear from the FOMC, get some economic data news into this, and we're at a point of support becomes resistance. It's clear as when we check it out from that perspective. If we think about the 15-minute chart, look at this. This is where things get interesting. We have a resistance, and I think everybody would agree, we have a bit of a support down here. And we'll move over to the futures market just to get a bit of an idea of how it's trading right now. Before, in the previous session, we had some basing, some kind of tests of the low and some basing, probably why it ended up going bullish. This is a coil at the point of where we know the bulls and the bears are fighting it out. Until we get a break, either bullish or bearish on this coil, we can't really be too sure about its next direction. So let's talk about both scenarios. The scenario where it goes bullish, closes above, any pullback back to this zone, you would think then will be met by buyer demand. All right, next stop, 45.20 makes sense. Now, that would be a pretty good day trade and certainly very open in the next session should it occur. But the bears are going to be saying, well, wait a second, what about us? Do we get to short it? Or maybe we want to cane this market back down. And they have a fairly good case. In fact, a lot of swing bears will be looking at this and saying, well, support becomes resistance. We're going to short this zone and we're going to be correct. That's what they're thinking. So if the market closes below this area, what's that really signaling? Not only filling the gap, but the real chance that we go down to that 4,300, 4,250 again and test the lows. It would be almost the perfect setup in terms of people's mentality and what's going to happen there. So we'll go back over to the SPY, and of course the easier short down will be trying to fill that range down to the 440. That's the gap fill that a lot of people are looking for. We know that if gaps are going to fill, there's a high statistical chance they fill in the next 2 to 3 sessions, like 1 to 3 sessions. We need to see them fill very quickly. Otherwise, it can really take quite a long time to fill these gaps. And while most gaps end up filling, we did the stats on it a while ago, I might share that, they don't always do it quickly. And if they do, it's got to be quick. Otherwise, it takes ages till they do end up filling. It'll be like some correction in the past that'll end up filling a whole bunch at once. So this is the movement that a lot of people are looking for in the next 24 hours. We will come back and obviously cover it. FOMC minutes, all these types of things. It's the first bullish move we've seen, but it's not out of the woods yet. And I think that's really important. We also need to remember that all the options are still pointing towards the market holding up for the week. We've got 425 and 430 getting stacked with puts for the expiration on the 18th. And even the week after, there's quite a lot of puts sitting around that 420. So at this stage, the market doesn't look like it really wants to go that much lower. It's going to consolidate, do what it's doing. Day traders are going to probably be the winners, and investors are going to be looking for that 460 plus. And if that happens, my goodness, investors are going to come in very hard, I'd say, into this market. Now, if you want to follow us before we get into the crypto, do so on FX Evolution on Twitter. And we do share some pretty good charts. Here's a chart that I shared in the previous session talking about Bitcoin and crypto, because we know that crypto has usually a bit of a slow start to it historically. And this is a chart taken from 2012 all the way through to now. And you'll notice that Feb, March, April sometimes can be a bit of a boom time for crypto. So if this holds true in terms of annual seasonality, we know October, November is, that's a time to be in the markets. But this is also the second best time to be in cryptos historically. So let's talk about Bitcoin. We've got that rejection candle. We know that if we manage to snap that and buy above it, we'd be able to get through the weekly 20, something that's held this market down, and basically put all the FUD to fear and take it out of the market and say, no, we're going long, crypto's back, baby, let's go. And that's certainly a scenario that seems to be trying to play out right now. We reported yesterday on the nice base that was forming here on the crypto markets. That's followed through. We're now at kind of the point of closure that's been big, about 44,500 on Bitcoin, but 46 is the key. That's the real resistance. And for a lot of bears, they're going to lose around 46. It seems to be the big level if we can break through it. Ethereum was the best trade in the last 24 hours in terms of the big two, because it had that really beautiful base. It was lagging a bit and it's continued up here, now trading at 31.79. That was a good base. We mentioned it in the previous video. It was really nice. It looks like it's got some more follow through to do, getting towards 33. And if, of course, we break through 33, we'd probably be expecting Bitcoin to be putting pressure on 46 at the same point. Both Ethereum and Bitcoin, whether you like trading them or not, or even investing in them, these are the ones that lead all the other crypto markets. And no other crypto market can really improve that much as a broad until these get through these key zones. So certainly important, and seasonality would agree with you. For the big news coming out, we've got some big, huge, unfortunate news. We've got core retail sales coming out 8:30 a.m. New York, Wednesday, Feb 16th. And then, of course, we have the FOMC meeting minutes at 2 p.m. Oh, my goodness, this Fed, what is it doing to us, guys? We're getting caned here in the markets from the perspective of up, down, and all around. It can be hard to navigate, but if you enjoy our videos, please remember to subscribe, smash that like button, and we'll continue to try to navigate these markets together.